When you open a chart, what is the first thing that catches your attention? Most people look at the candles. Some add indicators, while others search for chart patterns. But the most important information on the chart is often ignored. That information is volume. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. In reality, candlesticks only tell you what happened in the market, whether the price moved up or down. But volume tells you how much money was behind that move, how many traders participated at that level, and most importantly, whether the move is real or just a deception. In this video, we will learn how to read volume on a chart, what volume actually is, and how to use it in trading. I request that you watch until the end because I will also give you a checklist that you can use before every trade. Let's start from the very basics. Whenever you look at any chart, whether it is XAU-USD, BTC-USD, or any stock, the chart is speaking to you in 2 different languages at the same time. The first language is price, and the second language is volume. Candlesticks only tell you what the market did. They show whether the price went up, down, or consolidated in one place. In other words, candlesticks visualize price movement, but volume tells the complete story behind that movement. Volume tells you how many traders participated in that move, how many buyers and sellers were active at that level, and how much money was actually committed in that direction. Imagine that XAU-USD moved 100 points, and at the same time, volume was very high. This means many traders participated and committed their money to the move. Such a move is more trustworthy. On the other hand, if XAU-USD made the same move but volume was very low, it means very few traders participated. There was little conviction behind the move, and such moves often reverse later. Therefore, from today onward, do not only look at where the price moved, also look at how much volume was behind that move, because without volume, there is no real strength in the move. Now let's understand the most important concept. If you understand this, reading volume on a chart will become much clearer. This concept is called effort versus result. In the market, effort means volume, how much money is being committed at a particular level. Result means the candle, how far the price actually moved. When you analyze both together, the true picture of the market begins to appear. Scenario 1. High volume and big candle. If volume is high and the candle is also large, it means strong effort produced strong results. Everything is aligned. This is considered a healthy and reliable move. Scenario 2. High volume but small candle. This is the most important scenario. If volume is extremely high, but the price candle remains small, it means a huge effort was made, but very little result was achieved. This is a major warning sign. What usually happens here is that buyers are aggressively buying, while a large player, known as smart money, is quietly absorbing all those buy orders. In other words, smart money is selling into the buying pressure. They do it so skillfully that the price does not immediately fall. This process is called absorption. Once the buying pressure is exhausted and buyers become tired, there is nobody left to push the price higher. As a result, the market often falls sharply afterward. This pattern is easy to identify. If price reaches a resistance level and volume is extremely high, but candle sizes start becoming smaller and upper wicks become longer, it often means smart money is absorbing orders. In such situations, traders should avoid taking long entries near that level. Scenario 3. Low volume but price still rising. If price continues moving higher while volume remains very low, it does not necessarily mean the trend is strong. Instead, it means sellers are absent. There is nobody willing to sell at those levels, so the price can rise with very little effort. This situation is called no supply. The opposite is called no demand. If price is falling while volume is very low, it means buyers are not interested in buying, so the price drifts lower by itself. To summarize, high volume plus big candle equals healthy and genuine move. High volume plus small candle equals absorption and potential reversal warning. Low volume plus price move equals lack of participation from the opposite side. Now let's move to a concept that can completely change the way you look at volume. Volume spread analysis, also known as VSA. Most traders have probably never heard about it before. VSA was originally based on the work of Richard Wyckoff and later developed in greater detail by Tom Williams. Today, many professional traders use it worldwide. When traders look at volume, most of them only focus on whether it is increasing or decreasing. However, the real value of volume comes from understanding where that volume appears on the chart. For example, high volume in the middle of a trading range often has little meaning because buyers and sellers are simply exchanging positions. But when unusually high volume appears near a major support or resistance level, it becomes much more important. If the market approaches a key resistance level and volume suddenly expands, it tells us that a significant battle is taking place between buyers and sellers. The outcome of that battle often determines the next major move. Likewise, when the market reaches an important support level and volume starts increasing, it may indicate that large institutional traders are becoming active. This does not automatically mean the market will reverse, but it does tell us that something important is happening beneath the surface. This is why professional traders never analyze volume in isolation. They always combine volume with market structure, support and resistance, and price action. Volume alone tells you activity, price alone tells you direction. But when you combine the two, you gain a much deeper understanding of what the market is actually doing. The goal is not to predict every move. The goal is to identify where professional money may be entering or exiting the market, and then align yourself with that flow. At this point, you have learned some of the most important foundations of volume analysis, including the relationship between price and volume, the concept of effort versus result, signs of smart money absorption, and how stopping volume can signal a potential market reversal. And there's one mistake that more than 90% of traders make when reading volume bars. In part 2, I'll show you why that mistake causes so many traders to keep buying at the top and selling at the bottom. If you found this video helpful, make sure to hit the like button, subscribe to the channel, and turn on notifications so you don't miss part 2. Because in the next episode, you'll discover how to spot signs of market exhaustion before the crowd notices them, and how professional traders use volume analysis to find higher probability trading opportunities. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you.